Bank reconciliation myth busting. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in the Get Great Guitar homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. Before we get into the process of doing a bank reconciliation, I want to talk about a few misconceptions, a few myths about the bank reconciliation process. I want to do this because it's important to be clear about what the bank reconciliation process is. Many people are actually good at doing a bank reconciliation, even though they may not know exactly what the bank reconciliation is. And we want to basically understand that because the bank reconciliation is one of the main internal controls that we can have. The biggest internal control, which is going to be a guard against us making errors, is the accounting software itself because it forces us to do a double entry accounting system, which means the balance sheet is always in balance. Just using QuickBooks will allow us to do that. The bank reconciliation is kind of the number two thing, the biggest internal control thing we could do to verify that our data input is accurate. So we want to make sure to do that. If I get basically a bookkeeping system that is in QuickBooks without a reconciliation process, I have very less faith. My faith in the accuracy of the data goes down a lot. Now, it being in QuickBooks means that I feel better about it than if it wasn't in QuickBooks at all, and there wasn't basically a double entry accounting system being used. If it's just an income statement that's put together without any double entry accounting system and without the double check of QuickBooks, then that would lower my faith further, right? So the fact that it's in QuickBooks would raise my faith a bit, a good deal. And then the fact that we have a reconciliation to the bank statement would give me a lot more faith basically in general as well. So the two myths related to the bank reconciliation is, one, people often think that the process of doing the bank reconciliation is actually the bank reconciliation itself. And two, people often, and you see this a lot now because of the way the bookkeeping system is kind of changing, you got these automatic bank feeds, meaning you can kind of connect to the bank and be taking your data directly from the bank. Because we're taking our data from the bank many times, people start to think that that is the reconciliation, and therefore the bank reconciliation is obsolete these days. I've seen these things actually be said that the bank reconciliation is no longer relevant. The bank reconciliation is obsolete because of bank feeds, because you can link to the bank. And that's not true as well. So there's some facets that might change in the process of us doing the bank reconciliation, but it's not true that the bank reconciliation is no longer relevant. So let's take a look at those two things. The first is the process of doing the bank reconciliation. So versus what a bank reconciliation is. I mean, the bank reconciliation is the report that's going to be processed after you do the bank reconciliation. And the summary of a bank reconciliation is tying out our amount on the balance sheet as of a particular point in time for cash for a particular bank account to what is on the bank statement. And so you need something that looks kind of like this. This is in summary of a report that would be generated from a bank reconciliation within QuickBooks, which would be like, this is the cleared balance, meaning, and these are the items that are going to be in transit, have not cleared, meaning they're checks that have been written that haven't been cleared yet, or deposits that have gone into the bank we have recorded that have not cleared. So this report is really the bank reconciliation because it reconciles our books to the bank as of a particular point in time. And in so doing, it gives us more faith about all the data that we have input into the system. If we can say, in other words, exactly what the difference is, I can show you each and every check that is the difference to the penny, if possible, between the bank balance and the book balance, then that gives us more assurance that all the transactions are correct, because they have to be. If it's off by anything, if it's off by a few dollars, then it's quite likely that those few dollars are actually a result of multiple different transactions. So we really want to get it down as close as we can. Now, this is a summary report, so it doesn't really break out these items like we would like to see, the actual checks which are outstanding. So they have a detailed report that will break that out. It looks a little bit more confusing, but we'll take a look at it to break out those 5 checks when we go through the bank reconciliation process, because those are the ones you actually want to see the things that are outstanding. Now, realize that the book balance will not match the bank balance if you're doing a full service accounting system, because when you write checks and do things like that, you know that you wrote the check, but the check still has to clear the bank, meaning it's got to go to the other person has to clear it to their bank has to talk to your bank. So you know the check went out and you should record it at that point. but it hasn't cleared yet. It hasn't cleared the bank. Therefore, there's going to be this difference as of the same point in time between the books on your side and the books on the bank's side. It's just a timing difference. As long as you can account for that timing difference, then you can be assured that things are correct to some degree. So this is the actual bank reconciliation. What people tend to think is the bank reconciliation is the process of doing a bank reconciliation. In other words, if I go to the QuickBooks here, the bank reconciliation process will typically be going to the banking account and then saying reconcile, and then we'll start to enter this data. Now, you don't need to enter it now. We'll do this in a future presentation, but I'm just going to enter this mock data and continue. And here's the bank reconciliation screen. This reconciliation down here will show us the difference, meaning if I check everything off that is on the bank statement, if I reconcile basically with this worksheet, then this little worksheet will tell me that I'm at 0 down here, meaning that I've checked everything off, that I have reconciled. And the fact that I have reconciled with this little worksheet, people tend to think that that is it. Once I hit OK, I'm done. And it's true that you are done with the reconciliation process, right? This is the process of reconciling. But once you're done with this process, and we'll work through this process, we'll see this process, this isn't the bank reconciliation, this is doing the bank reconciliation. Once you're done with this, you can then, the system will create a report, which is the bank reconciliation. The report being this report. So this report will be generated after we do that process. And this report will show us a reconciliation of what is on our books in terms of cash, exactly what the difference is, outstanding checks and deposits, and then it'll tell us what is on the bank statement. So this actual statement is the bank reconciliation that will be generated from this process. So most of the time people will do this process, which is great, and then they won't look at the bank reconciliation. And maybe they don't need to look at the bank reconciliation, but you basically should understand that the bank reconciliation is that report. So when you talk to somebody like an auditor or something, they want the bank reconciliation. They don't want to see that you did this process. They want to see what the result of this process being done was, which will be that report, which is going to do that reconciliation, see what the outstanding accounts were. So we'll take a look at that a little bit closer later. The other thing that people often think of, I've seen this like a few times, that basically people are saying that the bank reconciliation is no longer relevant due to bank feeds. You have bank feeds, and so because you can connect directly to the bank, you don't need to reconcile at all. There's no bank reconciliation, and that's not true because, and let me see if I can kind of explain that. Notice you can connect directly to the bank, right? You can go to the bank feeds and you can get the transactions directly from the bank. But there is some confusion in terms of how you're going to apply the bank feeds. So there's a couple different ways that you can apply the bank feeds. Note that because you're getting the transactions from the bank, if you're doing a full service accounting system, like if you're in a fairly large company and you're in an accrual accounting system, you can't just do all your books from the bank statement, which you may be able to do for a small company. So if you want to just take the bank feeds and create the books from it in a small company, then that might be something that you can do. But if you're in a larger company that does a full service accounting system, you can't do that. So let's talk about that system first. Notice that, for example, we've seen these cycles as we go through our accounting system. If I have to create an invoice, which is going to increase the accounts receivable and increase sales, and then receive payment on that invoice and then deposit it, then the amount or transaction I get from the bank isn't going to be taking place until the deposit happens, either here or here. The amount of information, the information we get from the bank, in other words, cannot replace the invoicing process because that's an accrual type of transaction. So just realize that when you get the information from the banking system, you're not going to be able to create the entire books. The banking system is usually there for a double check on the books that you are putting together. In other words, you typically want to have the invoice, then you're going to receive the payment, you're going to record the deposit, and then you would like to go to the bank and you can use the bank feeds to kind of double check that the deposit has been received. Now, you can, in some cases, basically replace the deposit from the bank instead of recording it in your system. So, for example, and the easiest way to think about this is if you're at a small company and you want to depend entirely on the bank feeds, basically, to create your financial statements. So in other words, you're going to say, I'm not going to create an invoice. I'm not going to create a sales receipt. I'm just going to wait till everything clears the bank. And then I'm going to take that information and create my financial statements from it. If you do that, there's pros and cons to it. You can do that. But notice it's not a full accounting system because now you are no longer reconciling to the bank so much as just simply depending on the bank to create the financial statements. And again, you can do that, but it's a little bit different than a reconciliation process. You don't have the same kind of system of, I'm going to put it into the books on my side, and then I'm going to check it to the bank to reconcile the two. That's still what you're going to do, even if you do bank feeds and you have a full service accounting system, right? You'll typically do your flow on your side, then you'll import the transactions from the bank and kind of match them so that you can double check that happens. Now, as you do that, as you match your transactions to the banking transactions, that's similar to basically doing the reconciling process. You're basically kind of reconciling as you go. But remember, this process of reconciling is a process of reconciling. That's not the bank reconciliation. So you could kind of say, well, as I do that, I'm doing this, I'm reconciling. And that's kind of true. But again, that goes back to the same other kind of myth, whereas thinking that this reconciling is the bank reconciliation. No, that's going to be part of the reconciling process to be able to generate the bank reconciliation being the report. So then if you depend completely on the bank, then again, you're not reconciling, you're kind of waiting till the bank clears it. So for example, if you're on a complete cash basis system and you're saying, I'm not going to do a sales receipt or receive payment, I'm not going to use the accounts payable, I'm just going to write checks, possibly electronic checks and electronic receipts, wait till they clear the bank, and then I'm going to import that information from the bank, and I'm just going to rely on that data to create my financial statements. So in that case, you still want a bank reconciliation, but you're not really reconciling anymore because the reconciliation, to do it properly or more of a full service system, even on a cash basis, what you would want to do is say, okay, when I make a sale, I want to record the receipt of cash on my books, on my side, and then you would tie to the bank reconciliation to double check, and you would be checking, that would be reconciling. If instead you say, okay, I'm gonna basically bill the client, and I'm not gonna record the invoice, I'm just gonna wait till they pay me, and even when they pay me, I'm just going to wait till it clears the bank, which since it's an electronic transfer, it shouldn't take that long, right? So I'm just going to wait till it clears the bank. And then once it clears the bank, that's when I'm going to record it. Well, that means that you're just waiting till it clears the bank. So every transaction that you're going to download into your book will be the same exact transactions that are on the bank. That's not the case for a full service accounting system, even if you're using a connection to the bank for the bank feeds to double check some of your transactions. That's why you really kind of got to be careful in terms of how you're going to integrate your bank feeds into your accounting system. You got to know, am I going to be on a full cash basis system, and not only that, but be completely dependent on the bank, which you may want to do in a smaller type of business, might be able to do that if you have all electronic payments and whatnot. That might be a way to go. Or do I need to integrate the bank feeds into a full accounting system where I'm going to utilize accounts receivable and the accounts payable? So if you rely entirely on the bank and then wait till it clears the bank, you're still going to reconcile. And so I would still do this process, right? But when you reconcile, you're not really trying to reconcile your books to the bank because you created your books from the transactions directly from the bank. You're reliant completely on the bank. It's not like you're comparing what you did to what the bank did and seeing if there's any discrepancies between the two, because what you did was completely from what came from the bank. And so you'll still do this process, but what you're checking for is just to make sure that you downloaded all the transactions and you didn't duplicate the transactions. So when you tie out your books to the bank, that's what you're looking for. Did I get all the transactions from the bank properly? And did I duplicate any transactions? And that's what this will do. And then when you generate the bank reconciliation report, this will still be the process of doing the bank reconciliation. When you generate the bank reconciliation report like this, there will be no outstanding checks or deposits because there may be, really in real life outstanding checks and deposits. In other words, you might have written a check, and it didn't clear until after the cutoff date. but because you didn't record the check, you don't know it. You're not recording that on your side. You're just waiting till it cleared. So you're just waiting till it cleared. So all of your data is as of the same point in time as the bank statement because you're reliant on the bank. All your data's in there as of the bank. So you're still going to reconcile, but this report will be very, very plain because it's just going to say that the cleared balance has no reconciling items. It's going to equal the register balance. And so you might, but that's only the case. That's not the case whenever you use bank feeds. A big company that uses bank feeds will still have to reconcile outstanding checks and deposits. But if you're running typically a smaller company that might be all electronic type of payments, you might be able to depend directly on the bank, still do go through the bank reconciliation process, but you will not have any of these outstanding types of transactions. So those are the general kind of myths I just want to go into first. Next, we'll go into kind of the objectives of the first month bank reconciliation, objectives and problems of the first month bank reconciliation, which is a little bit more difficult and has different problems than second and third month or continuing bank reconciliations after that point in time. Then, of course, we'll get into the actual bank reconciliation for the first month.